right, so what we're going to do is let's jump into this podcast, and the whole idea is we're going to talk about, is this a bull run or a rug pull? And I know we talked about a little bit about it this morning. So let's start, Graeme. Why don't we start with you? You've got your hands on the pulse. So where are we? And are we leveled off with just a little bit of volatility, or do you think that we are now on a slow ascent to the heavens? And then, of course, will the halving, when it happens, how will that kick in for us?
Cool. So I'm going to zoom out a little bit. I think in order to predict where you're going to go, you need to know where you've come from. So I think if we zoom out a little bit, it will help us get some perspective. So obviously 2021, which was not last year, that was the year before, was an epic bull market. We saw the price head up to 60,000, 65,000. Many people expecting it even from that point to go much higher. We had the guys on Twitter with the laser eyes, which was all about the $100,000 Bitcoin, which obviously was never realized. So then we had last year, we had a big unraveling of a lot of that price appreciation. Bitcoin's down 80% off all-time highs. We've got altcoins off even more than that. So that was last year, and it was obviously a very tough year for the market in general. And now I think it's the right question to start asking, where is the market bottom? And maybe even more importantly than where's the market bottom, because that's a very difficult thing to answer. But the question is, where are we going to be in a year's time, in 2 years' time, in 3 years' time? Because if we can start to give some idea or give some logical thought to answering that question, then that tells us whether the current levels are a good long-term entry. And my answer to that is that yes, these are good long-term entries. I think that we are heading into a period of the market bottoming. I think we're seeing a little bit of that. We're definitely seeing the sting coming out of the downside momentum, at least. We've had a lot of bad news. We've had FTX, we've had Celsius, Voyager, BlockFi, the list goes on and on, Luna. So we've had a lot of bad actors come out of the market. And that can only be positive for the long-term prospects for digital assets. Does this mean that we go straight back into a bull market? No, I don't think so either, because I think the market needs to heal. I think it needs to recover. I think confidence needs to return. I think the market and many of the participants are still very hurt and very sore from the events of last year. So my expectations for this year is that we're going to see a period of rebuilding, a period of confidence being rebuilt, and that's not necessarily very bullish for the price. But I do think that this thing and the worst is over out of the bear market. Obviously, we need the macro factors to play along with us. The Fed was very aggressive last year in tightening rates. We had inflation running away. So that didn't build a bullish picture either. So that also needs to play its part for Bitcoin and crypto to give a decent upside performance. So
Graeme,
let
me ask this question, because when you say it's not very bullish, right? If we started the year with, and I'm just using Bitcoin, somewhere in the $16,000 range, and then we were up to 22, and if you think maybe it goes to 25, 24, 25, that's a 50% rate of return from 16 to 24. I would call that pretty bullish. Wouldn't you?
So look, it's a nice bounce, but I think if try to tell someone that that's a good result after they bought in at the market top at 60 or 65,000.
Sure.
They're still really hurt. They're still licking their wounds. And if you ask them about putting more money back into this market, they'd probably not be too pleased with you. So I think it's that sentiment and that battering that those type of investors have taken that we need to recover from. Because when we get these market bounces, there's still many in the market that are going to see this as an opportunity to offload what they weren't able to get out at previous levels. So my broad expectation, and look, we can always be wrong, is that we're going to see a lot of sideways action, a lot of chop and churn up and down as the market starts to build a base. I don't think you go from a big bear market that we've had in the last year just straight back into bull. This has been a nice rally that we've had at the start of this year. Maybe that means the market bottom is in, but I don't think it's to the moon and rocket
Oh,
ships and flying
okay.
saucers yet. I think we need to recover.
Okay, but for those people who bought in when it was a little higher, right? And I would say that the average person probably bought in a little bit on the way up, and I'm sure there's some people who did buy in at the 60,000. But anyone who bought in, if they have the long range look, right, that must mean they believe in the space. And so
Yes.
there's two types of investors, right? There's maybe those that bought in that it may make some sense now to start dollar cost averaging in. And clearly, for those who believe in the space but haven't, now would be a great time. And then
Yes.
maybe there's even a third type of investor, might be the one that says, you know what, maybe I want to reallocate some of my current crypto investments right now as a result of looking at the way different money managers manage, i.e., how we handle money. So, isn't it still, no matter what, good for everyone who looks at this? For those of you who are in, stay in. If this is a marathon, you don't judge how you're doing after the first mile. And for those who believe in the space, jump in and start your marathon whenever you're ready.
I agree. So I'll give a short comment and then I'll hand over. But for me, that's the what I would call the smart money mindset is to get in now at these type of valuations. These are the strongest hands that have still remained in the market, which is very positive. But your typical retail investor is not there yet, and that's often what drives the market price higher. So I think you've got smart money coming in. I think hedge funds are looking to allocate. People like ourselves are looking to start to build a position. And for me, that's the smart money. But then you need that layer of the strong hands, those high conviction players that are going to come in early to build that base. But I only expect the market to really get going once we're starting to see a more mainstream feel good factor about crypto and start to see some of the institutions come in, some retail starting to come in, and that's what then lifts the price off that base that we're building currently. And I think it's going to take months, not just days and weeks, to build up that base. That's my perspective. So yeah, I'll hand it over to some of the more experienced heads as well to give their
All
views
right.
of where we're at.
Bilal, um, I'd like, I'd like everyone to hear what your thoughts are for this year in terms of the cryptos, but I'd also like for you to talk a little bit about the Zenith Fund. And when you look at corporate America, public or private companies, I know that they keep a certain amount of money in the fixed type of instruments. And when you look at what we're now doing in our balanced Zenith Fund for that, how do you see the public and private larger companies where they have just cash sitting wherever? How do you see that piece of our portfolio, that fund sitting? So those are the two questions.
Yeah, great questions. Thank you, Larry. So, my market outlook is highly aligned to what Graeme shared in terms of what we would see on Spectrum, which is, we do need to take a marathon view, a 3 to 5 year outlook, and we'll be in a much better place than we are now. Where maybe I'm a little bit more bearish than Graeme in the short term is from a macro perspective. I think we are at the beginning of the recession, if you're going to define it as that, where the first things we're seeing are the job cuts, and I mean they're becoming more and more frequent in the news. On You watch the big names, even Goldman Sachs, talking about cutting jobs, and we've seen some crypto players also talking about cutting jobs. After we see job cuts become prevalent in many industries, what's likely to happen is the impact. Because what's happening here, right? We have inflation. Inflation is people spending money, and the Fed's trying to increase interest rates to cool inflation. So how do you stop people from spending money? You take away their money. So the whole point of rising interest rates is to create unemployment. And when you create that unemployment, people have less money, and then they spend less money. And the indicators of that will be now when the job cuts happen, then when the property sector reflects that people have lost their jobs and can't pay their mortgages, and you see wobbles on the property sector, and that's when I think the recession is looking baked in. Um,
But
we
Bilal,
then have.
let me ask this question. Doesn't the markets today reflect and bake in what you're saying? Or are you saying no, you have to wait till all those actual days that the people are no longer employed, then it kicks in? So I always thought the markets can see 6 to 9 months in advance.
Yes, so the markets at this point will be pricing in the possibility of what I've proposed at 30%, right? So as indicators, obviously this is just one bear case scenario. I mean, there's obviously bull case scenarios and many other scenarios which each have a percentage that they've been priced into the market. So it's not 100% priced into the market that's going to happen, because nobody knows the future. We just kind of guessing here. So the highest the probability that the market weighs on this recession getting worse would be priced in, and what then happens is, yes, the market does lead reality, and sometimes gets it right and sometimes gets it wrong, and so from a macro perspective, I think liquidity could get tighter. I think there is possibly, um, possibly we're starting to see the bottom. Possibly we're on the way to recovery, and the worst is over. It's also very possible that the worst is not over, and there are still job cuts and property scenarios ahead. And what we're doing is we are holding cash in Spectrum, to be deploying into those opportunities, because those will give us the best buy opportunities to set us up for the next few years in this amazing bull run. Um, so I mean, we are a mixed investment committee where we each have our views, and we debate our various uh, opinions. And yeah, so we need to just tread carefully and dollar cost average into the market where we see, um, potential risks ahead. So I'm sharing that in the context of the question as, is this a bull trap in our topic today? Is this a bull trap, or is this the bounces? Are we ascending to the stars from here? What I'm saying
Okay,
is,
let me ask this in relation to this piece. Is is what you just said a stronger pull on cryptos down, or is the previous history of Bitcoin's halving pulling it up? Which of the two do you think is stronger, or do you think one negates the other?
yeah, I think the macro factor is going to be stronger in my opinion. So I think in the short term, we may see the current price today of 21 something. We could see a pullback from that, which would give us better entry points for a long-term hold. And I mean, we're effectively looking at less liquidity in the market right now, or getting into less liquidity in the market, and that has to have an impact. Then you've got the cycle and the less supply, and the confidence in the dollar. I saw news today that, Russia and Iran are in talks. Well, I don't know accurate this is. I saw it on a website called centralbanking.com. So I don't know if that's an official central banking website, but they're talking about Russia and Iran forming a gold-backed crypto to transact alongside fiat. And I mean, this is a rumor that's been bubbling for a long time about the sanctioned countries all accumulating gold and making their play to move the world back to a Bretton Woods standard on gold, um, you know, um, which is in a cryptographic format, which makes sense. Um, so 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 that then would affect the dollar price of Bitcoin. The dollar price of Bitcoin could easily go to 100,000 if the confidence in the dollar reduces to that level. Um, so I think it's important to have some allocation to Bitcoin, Ethereum, to high quality crypto, um, commensurate with the risk profile of the particular investor. I always say, it's not 100% of your money. It's not 0% of your money. You should have some amount of your money allocated to crypto, and as opportunities present and prices improve, you can average in further. You shouldn't be at zero, and you shouldn't be at 100. So somewhere in between, and depending on your risk profile. And I mean, I think that leads to your other question about the Zenith fund. Um, where if you are sitting on the sidelines and you're not deploying into risk assets at this point, you might be sitting in a bank account or sitting somewhere trying to generate yield. And this is where Zenith fills that gap perfectly, where it gives you the monthly liquidity and it gives you a little yield of uh, you know uh, 50, 100 basis points per month, depending on what the market delivers. And that I mean, that's amazing. You're getting the monthly liquidity, you're getting a bit of return depending on what the market delivers. And when you're ready, I mean, the smart money at this point is getting ready to buy distressed assets. Like if we are going into a recession, you're going to buy property cheap. You're going to buy high quality stocks cheap. You want your money somewhere handy that when something positions itself, you're ready to deploy it. And Zenith is one of those things where you can have your money handy, for a fast opportunity. So it's all about balance. I mean, you need to have some crypto in your. I mean, it's good to have some crypto in your portfolio, and dollar cost averaging even at 20K now on a 5-year view, that's going to be a great price. Could you get a better price? Probably. And yes, okay. So dollar cost average in if you don't have any crypto yet, and then if you're looking to deploy into other opportunities, the Zenith fund is a great way to park some cash and have it ready to invest.
Okay. All right. One of the things I thought would be great since you brought it up. Can you imagine if Iran and Russia form Warcoin? They come out with a new crypto called Warcoin. And if they decide either one wants to go to war with any other country, the coin goes up. It's a home run. We should develop it. It's great. Unbelievable. So anyway, Glen, since you are Mr. Optimistic, which is always great, I think you told me once that if you were on the Titanic and it was going down, like you'd throw your bathing suit on and say, "What a great social activity they've provided." Look at this. It's kind of like the show Survivor. How cool that they offered this on the trip. So anyway,
that is delightful.
Interested in hearing. Yeah, tell me about your thoughts for the markets and everything, but I want you to coin it in this phrase or keep it in this perspective. If this is a marathon, it's a 5-year mentally, you put your money in. I don't care what. Where are we going to be, in your opinion, and what percentage would you bet well, not your life, but maybe maybe the wife's life on where are we going to be? What's the price going to be? Can you lose? Is there a better investment?
Well, Larry, thank you. To answer that question, we actually almost combine a few of our previous podcasts here. I think Graeme and B have touched on some of those items beautifully. And again, as always, we all generally aligned with our outlooks and analysis. But I want to emphasize a couple of points here. First and foremost, as Graeme said, the world's greatest investor, whether you Warren Buffett or the next guy, no one ever picks a bottom and no one ever sells at the high. And in addition to that, we are actually not traders. We are investors. So what does an investor do? He makes a decision, he takes a view on a particular asset class, and then builds a position. What does building a position mean? You get your best entry points when and how and when they present themselves. You've made a decision to allocate X% of your NAV, portfolio, net worth, whatever. And in our case, we are talking about digital assets, more specifically crypto, especially on a Spectrum fund. And I am delighted to say and see, because with the benefit of hindsight now, 2022 was a brutal test in terms of black swan events, whether it been mismanagement, bad actors, it doesn't matter. And general financial markets were incredibly volatile. We got some of the big blue chip companies down 30, 40, 50%, whether we're discussing Amazon, Tesla, Apple, whoever. And lo and behold, look at the resilience. If we just take Bitcoin and Ethereum as a point of reference, look at the resilience they've actually shown shortly after FTX and all the things I've just mentioned, and have recently had quite a strong little bounce. Now that to me as an investor and as a fund manager is a strong signal to build a position. I've just seen on my Bloomberg counter here, headline, early Ethereum backer raises 500 million to buy the crypto dip. So irrespective of what we're talking about, recessions and bull markets and blah, 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 we, as we said in previous podcasts, this is not going anywhere. This is here to stay. And I can tell you, and I mean this with absolute conviction and almost, passion, forget about being optimistic. We're going to be absolute idiots if we don't build a position here and fill our boots, irrespective of the volatility that may transpire or the sideways movement, because human beings have got short memories. Everyone's buying without thought at 68,000 and then are hesitant at 16, 17, and 20.
Yeah.
I mean, it makes no sense. And it being in the game for 25 years, it's incredible how that cycle repeats itself every single time. And it's almost as though we just, irrespective of the subject matter, we just don't learn from history. We just don't, we keep having wars. We don't build positions. I mean, it just keeps happening. A human being cannot learn from our own history. So, guys, it's given what happened last year, just to repeat myself as a closing statement, the sort of, to me, the support level shown at 16 and 17, using Bitcoin as a point of reference, has shown it's almost become a no-brainer to me. People should be taking the allocation, as B has said, whether it's 10% of their portfolio or whatever, and they should be coming to us because we've traded incredibly well during this winter period. Graeme is, we had our investment committee meeting earlier, and is looking to go a little bit more neutral in terms of his cash and crypto position. But I think it would be very, very silly for our investors to not add to the existing position, and for new investors not to approach us.
Okay. All right. Well, I think that covers pretty much what we want to chat about today. Guys, thank you very, very much. And we'll look forward to our next podcast.